The stock market has been steadily creeping up in price since March 2009, and with the exception of a few months, that pattern has even held true in 2020. As of this writing, the markets have already set new all-time highs following the crash earlier this year, and just closed out a very strong November where the S&P 500 rose some 9% for the month. But of course, the broader economy is still trying to recover from what was a very rough year. This has once again led to more voices suggesting that the stock market is overvalued, and considerably lower returns are on the horizon. So today, I thought I'd take a look at that idea and try to answer a few questions. First, and most obvious, are stocks overvalued? And if so, why might that be the case? Second, do stocks typically experience significantly lower returns in the years following being deemed overvalued? And if so, how big of a difference is there between the returns that we typically expect to see from stocks and the returns that we tend to see following those overvalued moments? And third, if stocks do seem to be overvalued and their future returns are historically noticeably lower following previous instances where they've been deemed overvalued, what can we as investors do about it to still make the most of our investments? But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So when it comes to stock market valuations, we've got to have some sort of measurement to determine whether or not something is historically overvalued. In the financial world, there are many metrics that try and fill this role. The most common one is probably the price to earnings, or PE ratio. It basically looks at the share price of a stock and divides it by the earnings per share of the company. So hypothetically, if a share of Apple stock was trading at around $100 a share, and Apple's financial statements showed that it was earning $1 per share, they'd have a PE ratio of 100. You can do the same general calculation for broad market indexes like the S&P 500 to get a general idea of how much money people are currently paying for every dollar of earnings in the market. And people have been doing this for years, so we've got a pretty good idea of what a normal PE ratio is for everything from individual companies and industries to the market as a whole. On your screen now, you'll see a chart illustrating the PE ratio of the S&P 500 since 1927. I've cut off the y-axis after a PE ratio of 50 so that we can see the majority of the results a little more clearly. In case you were wondering, that blip in 2009 that goes off the charts reached as high as 123 in June. I want to draw your attention to a couple of things. The first is that throughout much of this time, the PE ratio of the S&P 500 has hovered somewhere between 10 and 20, which makes sense given that the average PE ratio for the market is around 17 or so during this time. The second is that since the late 1980s and early 1990s, that average has been creeping up. Before the 1990s, there were only 2 times where the PE ratio of the market exceeded 25, which occurred in July 1933 and February 1934. Since January 1992, however, when the PE ratio finally rose above 25 again, it spent nearly a third of its time at or above that level. What's more is that since the start of the 1990s, the market's PE ratio has been above its long-term historical average of roughly 17.3, nearly 82% of the time. So that's a done deal, right? Case closed. The market is clearly overvalued. Well, maybe, but it's not necessarily that clear-cut. The PE ratio is probably one of the most common metrics quoted to determine whether an investment or market is overvalued or not, but just like any metric, it isn't perfect. For instance, say there was a company that was trading at $40 a share and earning 45 cents a share for a PE ratio of nearly 89. Would you say that that's overvalued? Well, unless this particular company was in an industry that traditionally carried much higher than normal PE ratios, then the temptation would be to answer yes. However, what if I told you that 6 months later, that same company's stock was trading at over $68 a share, and it was earning 73 cents a share for a PE ratio of nearly 94? Would it be overvalued then? Its PE ratio has actually grown larger, but then again, so has the share price. What if we looked even further into the future? Let's say that roughly 8 years down the road, the company's stock was trading at over $500 a share. Its earnings per share still stood at around 71 cents, so that hasn't changed much, but obviously because the price of the stock is so much higher, the PE ratio has exploded to over 700. Now it's gotta be overvalued, right? Well, as it turns out, no. Because the company is Amazon, which as of this writing is trading at over $3,000 a share with considerably higher earnings. The point I'm trying to make is that the PE ratio by itself lacks context. It can seem extremely high because the share price is overvalued, sure, but it can also be the result of any number of other reasons. Perhaps the stock is considered very stable during bear markets, so when people are expecting rough times, we see that price creep up a little faster than its earnings, thus raising its PE ratio. Perhaps it's because investors expect the company to see very fast earnings growth in the near future, so they try and buy into the stock before those earnings materialize in order to make a profit on their trades. Sure, it is entirely possible that those future earnings don't end up turning out to be all they were cracked up to be, and then we'd look back and say that, yeah, the stock was overvalued. But if the growth does materialize like it did with Amazon, then it's pretty difficult to say that the stock was originally overvalued. You get the idea. And the same can be true for the market as a whole. If investors are expecting bad times ahead, they may sell some of their shares in order to avoid the fallout, thus lowering the price of the overall market relative to earnings, or vice versa. But the fact remains that the PE ratio, as well as most financial ratios that seek to accomplish similar goals, are above their historical long-term averages, and have been growing for several years. So even with the limitations of these metrics, the very fact that they're nearly all pointing the same direction has got to mean something, doesn't it? And yeah, it probably does, but that something doesn't necessarily mean that stocks are overvalued. Consider this chart. It shows the cyclically adjusted PE ratio developed by Yale economics professor and author Robert Shiller of the S&P 500 from 1927 to 2020, along with the long-term interest rate. You'll quickly notice a pattern. Generally speaking, when interest rates rise, the PE ratio of the market falls, and vice versa. Not always immediately, of course, but that's the typical pattern. And this makes intuitive sense. People only have so much money to invest each month. If they can get really high, near-guaranteed returns through something like a long-term government bond, because interest rates are sky high, then they probably will funnel a little more of their investing money into that investment. And that's what we saw in the 1970s and early 1980s when long-term interest rates grew to over 15%. More money went into those bonds, and thus less money were going into stocks. Since less money was going into the stock market, the prices didn't rise as fast as earnings, and the PE ratio fell. Did that mean that stocks were overvalued? Not necessarily. It just means that relative to alternative investment options out there at the time, stocks were not as attractive of an option as they were in prior years. We've seen the reverse playing out through much of the past few decades. Interest rates have been falling, so those bond investments have become relatively less attractive compared to the potential returns of the stock market. And thus more of people's investment money is getting funneled into stocks. Beyond that, there's the fact that when interest rates are lower, money is considered to be cheaper. People tend to take on more debt to fund their lifestyle and use their cash to make investments that will, in theory, earn more in interest and appreciation for them than the debt they took costs them. Therefore, they would end up getting ahead. Sometimes this works, other times it doesn't, but it is something that happens, and it just serves to increase the pool of potential money being thrown into the markets and thus boosts stock prices. Beyond that, there have also been injections of free money into the markets by the government. This has also been a bolstering effect on the price of stocks, or any investment, since there's more money to be invested. So while traditional valuation metrics paint the stock market as being exceedingly overvalued relative to historical norms, it's difficult to say how much of that is because the market is genuinely overvalued and how much of it is down to other factors such as the relative lack of other high return investment options out there, the low interest rates leading to greater use of leverage, and the free money being pumped into the economy and thus the markets. Only time will tell us for sure. But since the metrics do suggest that stocks are overvalued relative to historical norms, I think that it's worth looking at what history suggests typically happens when the markets appear overvalued based on these metrics, like they do now. So I took a look at the average annualized real return of the S&P 500 over every 1, 3, 5, 10, and 20-year period since 1927. I then compared those returns to the real returns for each of those time spans for every month where the PE ratio of the S&P 500 was above 20, 25, or 30, to get a sense of how big of a difference there was in returns when the markets would have been considered overvalued by the metric. And here's what I found. For the time frame as a whole, the market's average real return was about 8.5% for the 1-year time frame. It was roughly 7% per year for the 3, 5, 10, and 20-year time spans. There is some variation in the exact figures simply because there are more available starting dates that we can measure with the 1-year ROI than we can for the 20-year ROI figures, but those are the rough averages. For the months when the PE ratio of the market was at least 20, those average returns drop fairly substantially to around 2.4% over the course of 1 year, 6% over 3 years, 5.4% for 5 years, 4.6% for 10 years, and 5.1% for 20 years. With a PE ratio that's at least 25, the 1-year returns actually increase to 2.6%, suggesting that some of the examples with a PE ratio of more than 20 but less than 25 had particularly poor short-term returns, but the rest of the figures do drop from where they were in the previous filter. The annual real returns for the 3, 5, 10, and 20-year spans were 1.1%, 3.4%, 2.7%, and 4.2% respectively. And with a PE ratio north of 30 like we've seen recently, the returns actually look better, almost across the board. The 1, 3, 5, 10, and 20-year results came out to 5.1%, 3.7%, 5.9%, 3.3%, and 3.7% respectively. The only one that came out behind the previous filter is that 3.7% annual return for the 20-year time span. However, all of those figures are below the historical averages, suggesting that when metrics like the PE ratio have been elevated, the future returns of the S&P 500 have been below average. But that hasn't always been the case. I also looked at how the 1, 3, 5, 10, and 20-year real returns following the date when the market reached those higher PE ratios compared to the real returns for the same time frames leading up to that date, to see if the market underperformed its own recent history when it appeared overvalued, or if the price momentum of the market tended to keep going up at the same or even a better clip. And the results are fairly mixed. When the market has a PE ratio of over 20, the following year's real return has actually overperformed the prior year's return roughly 40% of the time. That is less than half, but it does show that the short-term performance of the market is not too easy to predict, even when it appears overvalued. The water's muddy even more when looking at the data over a 3-year span. In that case, the markets actually overperformed their prior 3-year returns in 58% of cases, which is a little more than half. The 5-year results are very similar to the 1-year results, with roughly 40% of the cases showing future overperformance. To me, this suggests that even when markets have appeared overvalued by traditional metrics, the short and even intermediate term returns are fairly hard to predict. Yes, they may be lower than the 93-year average would suggest in the majority of cases, but that doesn't mean that they will actually be worse than what the market has been achieving in the recent past. Over longer time frames, the data does become more clear, with roughly 2/3 of the 10-year stretches underperforming their recent past, and nearly 9 in 10 of the 20-year stretches falling short of those recent results. The pattern of near coin flip odds for overperformance in the short and intermediate term and less than stellar performance in the long term holds true if we look at just instances with PE ratios of over 25 or 30 as well, suggesting that regardless of whether the market appears moderately overvalued or significantly overvalued, the predictability of future returns, or lack thereof, doesn't change all that much. Which brings us to the big question of this video. Given that the future returns are, on average, lower than the long-term figures would imply when markets are appearing overvalued based on traditional metrics, should we change anything with our own investments to get the most out of our nest egg? Well, as usual, that's going to depend on your current investing situation and goals. But I did run some tests to see what would typically happen to someone who changed up their investing strategy when the markets reached a specific PE threshold, compared to if they just stuck to their original plan. Let's say that John had $500 a month to invest into either the S&P 500, bonds, or some combination of both from 1927 through the end of November 2020, which is the most recent completed month of data I have available to me at the time of this recording. If we had a time machine and were able to let him start his investing journey in every single available month during that time frame, what would his net worth typically grow to 30, 40, and 50 years down the road after adjusting for inflation? If John had invested all of his money in the S&P 500 and kept investing it there regardless of how over or undervalued the market got, his average inflation-adjusted net worth after 30 years would have been around $383,000. After 40 years, it would have grown to, on average, around $688,250. And at 50 years, he'd be looking at around $1,374,000. If instead he had changed to investing in bonds when the market became too overvalued for his liking, he would have actually generally come out behind. If he began investing his money into bonds whenever the PE ratio of the S&P 500 rose above 20, his net worth would have clocked in at around $358,000, $642,000, and $1,304,000 in the 30, 40, and 50-year scenarios respectively. As you can see on your screen, if he had waited until the PE ratio rose to over 25 or over 30, his net worth would have improved, but not enough to beat out what would have happened had he just stayed the course and continued investing in the stock market. We see a similar but slightly different story play out if John actually sells out of his stock market investments when the market becomes too overvalued and then moves all of his money into bonds. If he sells when the PE ratio of the market rises above 20, he still comes out behind, but if he waits until it rises above 25 or 30, he does narrowly come out ahead. But take a close look at those net worth figures. Even in the best scenario where John waits until the PE ratio rises above 30, his net worth figures are only slightly ahead of where they would have been had he just stayed the course. Even at the 50-year mark, John has a net worth of $1,437,000, compared to his staying the course net worth of $1,374,000. Now, $63,000, especially when it's already been adjusted for inflation, is nothing to sneeze at, but a mere $63,000 difference between these two net worth figures is not all that large, especially after 50 years of investing. And this is without considering things like tax consequences or trading costs that could eat away at, or possibly even completely wipe out, that difference in this scenario. So are stocks overvalued? Maybe. Traditional metrics certainly do seem to suggest that they are, but overvalued is a relative measurement. I don't think that most of us would have considered Amazon to be overvalued back in the mid to late 2000s, even if its PE ratio got pretty high. And we saw where that went. Granted, not every company is Amazon, but you get the point. Time will ultimately tell whether or not the market is overvalued. And even if it does turn out that stocks are currently overvalued, that doesn't necessarily mean that they're an inherently bad investment, or even that they will underperform their recent results, let alone the results of whatever alternative investment options you might decide to throw your money into right now. Now, does that mean we should all be 100% invested in the stock market? Of course not. It means that if we haven't already, we should take the time to think about what we want to get out of our investing journey, and then figure out what asset or mix of assets is going to give us the best chance of achieving those goals. If that ends up being a 100% stock strategy, then by all means, go for it. Many people have, and historically the long-term returns have been very solid, especially compared to most other common asset classes. But the key is going through that process and coming to a decision that gives you the best chance to get what you want to get out of your investing journey. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.